Good evening tonight. What you're about to hear could reshape how the Federal Reserve operates for the next decade, and more importantly, what that means for your savings, your mortgage, and your retirement. Kevin Warsh, the man nominated to be the next Federal Reserve Chairman, just delivered a bombshell statement before the United States Senate. He didn't come to protect the institution, he came to hold it accountable. He called out a fatal policy error, one that dates back 4 to 5 years, and he says Americans are still paying the price right now. We're breaking down every word of this testimony and what it means for your money. Here's the backdrop you need to understand. Since 2021, the Federal Reserve has presided over the worst inflation crisis in more than 40 years. By most measures, the cost of everyday goods rose between 25 and 35% for working American households. The Fed held interest rates near zero, while Congress injected over $5 trillion in stimulus into the economy. Most economists sounded the alarm. The Fed called inflation transitory. They were wrong. And the consequences, higher mortgage rates, record credit card debt, and persistent price pressure at the grocery store are still with us today. Now the man who may be tasked with cleaning this up just went on record before Congress. Warsh says after COVID, when prices went up to the tune of 25-35% for virtually all deciles of the American people, that's an indication that the Fed missed its mark, and we are still dealing with the legacy of the policy errors in 2021 and 2022. Once you let inflation take hold in the economy, it's more expensive and harder to bring it down, and so the fatal policy error going back 4 or 5 years is still a legacy that we're dealing with. We need, in my judgment, fundamental policy reforms to fix it. Let that number sink in, 25 to 35% across virtually all income levels. Warsh isn't referencing wealthy investors who could hedge with assets. He's talking about working-class families, retirees on fixed incomes, small business owners who couldn't absorb a price shock of that magnitude. When a Fed nominee looks a Senate panel in the eye and says the Fed missed its mark, that is the most powerful financial institution in the world being held accountable for a generational failure. Policy errors in 2021 and 2022. Here's what makes this significant. Warsh is naming the specific years, 2021 and 2022. These are the years the Fed held rates near zero while the economy was being flooded with stimulus money. Most economists warned that this was inflationary. The Fed said don't worry about it. They were wrong. But here's the part that should concern every investor in this audience. The legacy of those errors is still embedded in the prices you pay today, and it is still embedded in the interest rate environment your mortgage, your car loan, and your business credit line are being priced against right now. Once you let inflation take hold, this is the critical insight buried inside that statement. Inflation isn't just a number on a government chart, it is a psychological force. Once businesses raise prices and consumers begin to expect higher prices, it becomes a self-reinforcing cycle that is extraordinarily difficult to reverse. That is why the Fed was forced to raise rates to 5.25%, the highest level in 23 years. And that is why, even as rates come down, the damage is still being felt in every corner of the American economy. But will a new leadership structure at the Fed be enough to break that cycle? Fundamental policy reforms, and here is where this gets directly personal for your portfolio. Warsh is not just criticizing the past, he is signaling a structural shift in how the Federal Reserve will operate under his leadership. Fundamental policy reforms means changes to how the Fed measures inflation, how it communicates policy decisions, and most importantly, how it manages a balance sheet that currently sits at nearly $7 trillion. For investors, this is the setup you need to be tracking heading into the second half of 2026. But here is the layer that most financial channels will not cover. While Warsh is pushing for transparency and accountability at the Federal Reserve, there is a parallel story playing out inside the halls of Congress itself. Members of the Senate Banking Committee, the very committee that questioned Kevin Warsh, have continued to actively trade financial sector stocks in the months leading up to this hearing. According to publicly available congressional financial disclosures, several senators on that committee hold significant positions in banking ETFs and financial institutions directly regulated by the Federal Reserve. These are the people asking the questions, with a personal financial stake in the answers. That is not a conspiracy theory, that is public record, and it is exactly the kind of insider access that the everyday investor does not have. So what does this mean for your money right now? 3 things to watch. First, if Warsh moves to rein in the balance sheet as signaled, expect bond market volatility. Duration risk becomes real again. Second, financial sector stocks may face headwinds if the Fed's regulatory posture tightens under new leadership. Regional bank ETFs are worth monitoring closely. Third, the policy reform narrative is historically bullish for hard assets. Gold, Bitcoin, and commodities tend to perform when confidence in the Federal Reserve framework begins to erode. We are tracking all 3 of these closely. We are going to continue tracking Warsh's confirmation and what it means for your financial future. In our next video, we are going deep on the Federal Reserve's $7 trillion balance sheet, what it actually is, who benefits from it, and why the unwinding of that balance sheet could be the biggest financial story of 2026. Please like, comment, subscribe, and share for more.